All right, let's dive right in because we have a really fascinating puzzle on our hands today. We're looking at one company, Barrick Gold, but there are two completely different stories being told about what it's worth. One story says it's a terrible investment, the other says it's this massive opportunity. So the question is, how can both possibly be true at the exact same time?
And that's really the core question, isn't it? How can one of the biggest gold miners on the entire planet be seen as wildly overpriced by some folks and an absolute steal by others? It's a paradox that honestly gets right to the heart of how we even think about a company's value.
And wow, this just lays it all out there. On one side, you've got the conservative analysts saying, the company's worth maybe 30, 40 bucks a share. But on the other side, if you just run the numbers based on today's gold price, the math screams it should be worth a staggering $130. I mean, that is a huge, huge gap. Let's break down how this is even possible. To really get our heads around this, we have to explore this stock's double identity. It's almost like it's living in two parallel universes at the same time, and we're going to take a little trip to both of them. So right in the middle of all this is Barrick Gold. They're a huge global producer, and obviously their value is tied to the price of gold. But as you're about to see, the real story here isn't just about the company, it's about two completely different philosophies for trying to predict its future. Okay, so let's start with perspective number one, the cautious long-term analyst. You can think of this as the voice of history, the voice of prudence. Now, to get this view, we have to talk about something called net asset value, or NAV. It sounds complicated, but it's pretty simple. All it is what you'd get if you sold off all the company's assets, in this case, all the gold in the ground, and then paid off all its debts. It's just a fundamental look at what the company is actually worth. So the core idea here is all about history. These analysts, they look at decades of data, and they basically assume that even though gold prices are super high today, they're going to come back down to the long-term average. So they plug in a really conservative gold price, something like 2,050 bucks an ounce, and their NAV calculation spits out that $30 to $40 valuation. And their conclusion, well, at its current price, the stock is it's overvalued. This analogy just nails it. It's perfect. They're not paying attention to the current heat wave of high gold prices. Nope. They're betting that the long-term climate of the gold market is what really matters. It's a safe, conservative bet based on a whole lot of history.
Okay, but what if today's heat wave isn't just weather? What if this is the new climate? And that question brings us to our second and much more dramatic perspective, the spot price reality.
This viewpoint, it just throws history right out the window. It basically says, look, I don't care what gold was worth last year. I care about what it's worth right now. And when you do the math based on today's numbers, well, that's when things get really, really interesting. So first, let's look at the revenue. This model uses today's spot price for gold, which for the sake of this argument, we'll say is a record-breaking $5,000 an ounce. So for every ounce Barrick pulls out of the ground, that's what they can sell it for, right now.
Now here's the cost side, and this is absolutely crucial. While the selling price has just gone through the roof, Barrick's actual cost to mine that ounce of gold, what they call their all-in sustaining cost, that stayed pretty stable, right around 1,600 bucks. And here is the big aha moment. You take that $5,000 in revenue, you subtract the $1,600 in cost, and you are left with a massive profit margin of $3,400 for every single ounce. Let's just let that sink in for a second. In that conservative model, the profit was maybe $450 an ounce. In this reality, it's $3,400. That is an 8.5 times explosion in how much money they make. So when you recalculate the company's net asset value with these numbers, that's how you get that giant $130 per share target. So here we are. We've got two completely logical but wildly different valuations. We have the conservative past on one side and the explosive present on the other. So where does that leave the actual stock price today? And just look at this. This chart says it all, doesn't it? You've got the cautious, history-based number way over on the left, and then the super optimistic spot price number way over on the right. The gap between these two perfectly logical conclusions, it's just enormous. And here's the hard data that drives that visual. You can see all the assumptions lined up side by side. The entire difference, the whole story, comes down to just one number. Which gold price do you believe is the real one? The historical average or the price right now? One of them makes the stock look overvalued, the other makes it look like an incredible bargain.
So, what's the market actually doing with all this? Well, it's kind of hedging its bets. With the stock trading somewhere around 45 to 50 bucks, it's higher than the conservative value, for sure, but it's nowhere close to that spot price value. And what that tells us is that the market is a little skeptical. It doesn't fully believe this $5,000 gold price is going to stick around for the long haul.
And that brings us to the final and really the most important part of all this. Because at the end of the day, the right answer, it depends entirely on you. So here's the crucial takeaway. Valuation isn't just about math on a spreadsheet. It's a story about the future. Do you believe in the long, slow arc of history where prices always seem to find their way back to the average? Or do you believe we've hit some kind of new era where today's high prices are the new normal?
That is the billion-dollar question you have to answer for yourself. Is this incredible price just a temporary heat wave, or is this the new climate? The answer you choose determines whether a stock like Barrick Gold is a risk you should avoid, or maybe, just maybe, the opportunity of a lifetime. Thanks for joining me.